Welcome to our deep dive today into Mark Spitznagel's The Tao of Capital.
Hmm.
We're going to explore how he blends Daoist philosophy and Austrian economics to kind of navigate, the market's complexities. It's a unique approach, to say the least. I'm very curious to see how these seemingly disparate ideas work together.
Yeah, it's really fascinating how Spitznagel, a highly successful investor, uses these seemingly, totally unconnected areas to understand markets. And I think what's even more intriguing is the paradox at the heart of his philosophy. The idea that embracing loss, patience, and a roundabout approach can lead to greater gains in the long run.
That definitely goes against the grain of, what we usually hear about investing.
Absolutely. Spitznagel really challenges conventional wisdom by drawing inspiration from Taoism. One of the key concepts he highlights is wu wei, often translated as non-coercive action.
Okay, let's unpack this wu-wei concept a bit. I'm familiar with it in, a general philosophical sense, but how does it apply to investing?
So think of it as working with the natural flow of the market rather than trying to impose your will upon it. So Spitznagel believes that, like a Taiji Chuan master redirecting an opponent's force, investors can profit by patiently waiting for and exploiting market imbalances.
So instead of trying to predict the market's every move, you're waiting for those moments when the market reveals its own vulnerabilities.
Precisely. And he learned this from his experience as a pit trader at the Chicago Board of Trade, where he was mentored by a veteran trader named Everett Klipp. And Klipp had a saying that really embodies this idea. He said, "You've got to love to lose money, hate to make money, love to lose money, hate to make money."
Okay, that sounds a bit counterintuitive. Can you elaborate on what he meant by that?
It's all about discipline and timing. Klipp believed in taking many small losses quickly, but holding on to winning trades longer for potentially larger gains. And this requires a certain depth of field. The ability to perceive a long span of forward moments, not just focusing on the immediate.
So it's not just about reacting to what's happening right now, but understanding how today's actions might play out over time.
Exactly. And that long-term perspective is where Austrian economics comes in.
Okay, starting to see how these pieces fit together. Can you tell me more about how the Austrian school informs Spitznagel's approach?
Sure. The Austrian school, particularly the work of Ludwig von Mises, emphasizes that markets are dynamic processes constantly seeking balance, with each price being an error around an ultimately unattainable final state of rest.
So the market is always in flux, trying to find equilibrium, but never quite getting there.
Precisely. And for investors like Spitznagel, much like those pit traders he observed, understanding this process allows them to identify and capitalize on those errors or imbalances.
So Spitznagel is combining this Taoist idea of wu-wei with the Austrian understanding of market processes to create his investment strategy.
Yes. He's looking for those moments when the market is out of sync, and then rather than fighting against the current, he's positioning himself to profit from the market's own attempt to rebalance.
So instead of predicting the future, he's waiting for the market to reveal its hand and then playing his cards accordingly.
Exactly. That's the essence of his roundabout approach. He aims to exploit market distortions, often caused by things like central bank intervention. But instead of trying to time the market perfectly, he prepares for and profits from market dislocations.
This all sounds very strategic and, dare I say, patient.
Patience is key. It's about understanding the intertemporal nature of markets and not getting caught up in the short-term noise. This is where the depth of field we talked about earlier becomes so important.
So for Spitznagel, it's not about chasing quick wins, but about setting yourself up for long-term success by understanding the underlying forces that drive the market.
That's a great way to put it. It's like that Taiji Chuan master again, waiting for the opportune moment to strike with maximum impact.
This is all incredibly insightful. But I'm curious to hear more about how Spitznagel actually applies these principles in practice. What does his investment strategy look like on a day-to-day basis?
That's what we'll explore further in the next part of our deep dive.
I can't wait. This is already giving me a whole new perspective on how to approach the market.
So you're curious about how Spitznagel puts this roundabout approach into action. It's not just about sitting back and waiting for the market to crash.
Right. It sounds like a very active strategy, even if it is, driven by a philosophy of patience.
Yeah, you're right. He's not passively waiting.
Yeah.
He's carefully constructing a portfolio that's designed to not just weather market storms, but actually benefit from them.
That's where that concept of convexity comes in, right? He mentions it quite a bit in the book.
Absolutely. Convexity, in simple terms, is the potential for outsized gains when the market makes a big move.
Okay.
Think of it as a lever that amplifies your returns during a market downturn.
So he's not just trying to avoid losses, he's actively positioning himself to profit when things get volatile.
Exactly. And one of his primary tools for achieving this is options, specifically out-of-the-money put options.
Can you remind me how put options work in this context? I know they give you the right to sell an asset at a certain price, but how does that play into profiting from a market downturn?
Think of it like an insurance policy. So if the market crashes and the price of the asset you hold, put options on, plummets, those options become extremely valuable.
Okay.
They allow you to sell at that predetermined higher price, offsetting your losses elsewhere in your portfolio.
So it's like having a safety net that not only catches you when you fall, but also bounces you back up.
That's a great analogy. And the key to making this work effectively is, as we've been talking about, understanding the intertemporal nature of markets.
Meaning you need to be able to anticipate those moments of market dislocation.
Exactly. Spitznagel isn't trying to predict the exact timing of a crash, but he understands that they are an inherent part of the market cycle, especially given the distortions created by central bank interventions.
Which brings us back to the Austrian school of thought. It seems to provide the framework for his market analysis.
Precisely. Austrian economists view the market as this constantly evolving process, seeking balance, but always being nudged off course by external forces, particularly government intervention in the economy.
So it's almost like they see the market as like a living organism that's constantly trying to find its equilibrium.
That's a great way to put it. And those interventions, whether it's manipulating interest rates or implementing price controls, create these imbalances that the market will eventually correct, sometimes quite violently.
Which creates those opportunities for those who are prepared. Those who have, as Spitzengel would say, the necessary depth of field.
Exactly. It's about seeing those interventions not as solutions, but as the seeds of future market dislocations.
Okay.
And that's where Spitznagel's roundabout approach really shines. He's positioning himself to benefit from those inevitable corrections.
This is all starting to make sense, but I have to admit it seems pretty different from the advice you usually hear about investing. You know, diversify your portfolio, buy and hold, ride out the storms.
It is a contrarian approach. Spitznagel isn't afraid to challenge conventional wisdom. He's not dismissing those traditional ideas entirely, but he's viewing them through a different lens.
It seems like the key difference is that he's not just trying to mitigate risk. He's actively seeking it out, but in a calculated and strategic way.
Exactly. He sees those market dislocations not as something to be feared, but as opportunities to generate significant returns.
But doesn't that go against the whole idea of diversification? If you're specifically positioning your portfolio to benefit from a market crash, aren't you putting all your eggs in one basket?
Not necessarily. Remember, Spitznagel still emphasizes the importance of diversification, but he takes it a step further.
I see.
He believes in diversifying across different asset classes, including those that are often overlooked or considered alternative. Things like precious metals, real estate, and commodities.
Are those assets in particular?
Because they tend to behave differently than traditional stocks and bonds, especially during periods of market stress. They can act as a hedge against inflation or a declining dollar, for example, and they can help to stabilize a portfolio during those market routes when stocks and bonds are plummeting.
So it's not just about diversifying across different companies or industries, but across different types of assets that respond to economic shocks in different ways.
Exactly. He's creating a portfolio that's not only resilient to market downturns, but can actually benefit from them, almost like a shock absorber that also acts as a spring.
This is fascinating. It's almost like he's playing a different game than most investors.
In a way, he is. He's not just trying to beat the market. He's trying to understand the market's own internal logic and work within those parameters.
And that logic is informed by both Taoism and the Austrian school. It's amazing how he's been able to synthesize these seemingly disparate ideas into a cohesive investment philosophy.
It's a testament to his intellectual curiosity and his willingness to look beyond the conventional.
But is this something that only sophisticated investors like Spitznagel can do? Can the average person, someone without a team of analysts and access to complex financial instruments, apply these principles?
That's a great question, and one we'll explore further in the next part of our deep dive.
I'm looking forward to it. This has been incredibly insightful, but I'm curious to hear how we can all learn from Spitznagel's approach, even if we're not managing a multi-million-dollar hedge fund.
You know, one of the things that really struck me while reading The Tao of Capital is how Spitznagel emphasizes the importance of understanding not just markets, but also business cycles.
That makes sense. After all, businesses operate within that, broader economic landscape. and
Yeah.
their success or failure is often tied to those larger cyclical swings.
Exactly. And Spitznagel, being heavily influenced by the Austrian school, sees these cycles as natural outcomes of the market process, not as random events or failures of capitalism.
Can you elaborate on what the Austrian perspective on business cycles is?
Sure. So Austrian economists believe that cycles are often triggered by artificial credit expansion, typically driven by central banks, trying to stimulate the economy.
So when central banks lower interest rates and make it easier to borrow money, it creates a boom, but it's not a sustainable boom.
Great. This easy money leads to malinvestments, businesses making decisions based on distorted price signals rather than genuine consumer demand.
So it's like building a house on a foundation of sand. It might look good for a while, but eventually the tide comes in and the whole thing collapses.
That's a great analogy. And when that correction inevitably comes, it's the businesses that have been most reliant on that artificial credit that suffer the most.
And this is where Spitznagel's roundabout approach comes in, right? He's looking for opportunities to profit from those dislocations, those moments when the market is forced to rebalance.
Precisely, he understands that those artificially inflated bubbles will eventually burst, and he's positioning his portfolio to benefit from those corrections.
But isn't that a bit risky? It
Yeah.
seems like you'd have to be very good at timing the market to pull that off.
Yeah. Well, it's not about timing the market perfectly. It's about understanding that cyclical nature of markets and recognizing the signs of an impending downturn. Remember those errors or imbalances we talked about earlier? They become more pronounced as the cycle progresses.
So he's looking for those warning signs that the boom is turning into a bust.
Exactly. And he uses a combination of economic data, market indicators, and even historical patterns to identify those turning points.
So it's not just about picking individual stocks. It's about understanding the larger macroeconomic forces at play and positioning yourself accordingly.
Precisely. It's about having that depth of field we discussed earlier, seeing beyond the immediate and understanding the long-term consequences of those economic policies and market trends.
This is all incredibly insightful, but I'm wondering how this Austrian view of business cycles translates into actionable investment advice for the average person.
Well, first and foremost, it highlights the importance of not getting caught up in the hype of a boom. Remember those periods of easy money often lead to irrational exuberance and bad investment decisions.
So don't follow the herd when everyone is rushing into the latest hot stock or asset class.
Exactly. It's about staying disciplined, sticking to your investment strategy, and not chasing those quick gains that are often unsustainable.
So even during a boom, it's important to maintain a cautious approach and be prepared for that eventual downturn.
Absolutely. And that preparation might involve diversifying your portfolio with assets that tend to perform well during periods of economic uncertainty, as we discussed earlier.
Things like precious metals, real estate, and commodities.
Exactly. It's about having a portfolio that can weather those storms and even benefit from them.
This is all making a lot more sense. Now, it's not just about picking winning stocks, but about understanding the larger forces that drive market cycles and positioning yourself accordingly.
Precisely. And it's about having the patience and discipline to stick to your strategy, even when it seems like everyone else is getting rich quick.
Which brings us back to that Daoist concept of wu wei, working with the natural flow of the market rather than trying to force your will upon it.
Exactly. It's about understanding that markets have their own rhythm, their own cycles of expansion and contraction.
And the key to success is not to fight against those cycles, but to learn how to ride them, to use those moments of correction to your advantage.
Precisely. And that's the essence of Mark Spitznagel's The Tao of Capital, a philosophy that combines ancient wisdom with modern economic theory to create a truly unique and, as his track record shows, a remarkably effective approach to investing.
This has been a fascinating deep dive. We've covered so much ground, from Daoist philosophy and Austrian economics to the practical applications of Spitznagel's investment strategy.
Yeah, it's been a pleasure exploring these ideas with you.
And to all our listeners out there, we encourage you to continue exploring these concepts, to challenge conventional wisdom, and to develop your own unique approach to navigating the complexities of the market. Until next time, keep diving deep.